You may have heard someone says, my property is in a trust, so I pay less tax. Sounds like bragging that they are smarter than you. But before you go and copy them, stick around for a few minutes with me, and by the end of this video, you will know exactly which ownership structure fits your goals and your situation. Today, I'll be covering 5 ownership structures and pros and cons of each structure in details. So if you want to know what they are and how they can actually benefit you, please keep watching. Hi, I'm Eric Lee. I'm a chartered accountant and a licensed real estate agent. Every week, I merge both expertise to help investors grow their wealth without nasty surprise because of tax. You ready? Let's get down to the main topics. Firstly, the simplest way to hold properties is buying it under your own name. You own 100%, you sign everything, you and only you. Pretty simple, but you also take all the risks. Many people own properties under their own names because of the simplicity, meaning you sign it all and all done. Also, more likely, banks would request less documents for a loan application. Especially when you're employed, probably a few payslips will do the jobs. Also, you can access to the 50% CGT discount after 12 months. However, if something bad happens to you, properties under your own names are at risk. And you cannot split the income to reduce your tax during ownership or when you sell and pay CGT, especially when you are already at highest marginal tax rate of 47%, including Medicare levy. Buying property under individual names are best for first investment property buyers on lower income bracket who want speed, minimal admin, and are happy to wear the risk, which is typically quite low in many circumstances. So in summary, pros cons of individual ownership is like this. Okay, the second option is to own jointly with someone else. Joint ownership is actually nothing special because same principle applies as an individual, including the risk factors, but just more than one person. However, there's a key note for you today. When you own properties or any other asset jointly, there are 2 different ways of doing it. Joint tenancy versus tenancy in common. As this is not a legal lecture, I wouldn't get into it too deep today. But joint tenancy basically is the equal ownership between joint owners, and tenancy in common is fixed entitlement is set when signing the contract. For joint tenancy, when one party is deceased, the ownership will automatically get passed on to the survival owners. But with tenancy in common, the ownership of the deceased works like an independent asset and not automatically passed on to other joint owners. If you have seen people have like 99% and 1% joint ownership between husband and wife, probably it was set up for the purpose of tax savings. That way, as tenancy in common, they can actually avoid getting taxed in 50-50, especially one party's marginal tax rate is higher than the other. And be aware that your borrowing capacity can be severely affected. When you buy a property with someone like 50-50, you think that you borrowed the 50% of the loan, so it only impacts your borrowing capacity as much. But unfortunately, that's not the case. Banks actually will assess your borrowing capacity for your next investment project, assuming that you borrow 100% of the loan, because banks want to protect themselves from the situation that any of joint borrowers experience financial difficulties. I generally advise people not to buy property in joint names, especially with people rather than your spouse because of this reason. For your information, summary of pros and cons of joint ownership is like this. The third structure is a company, which is not usually the favorite structure of many investors because companies do not have access to 50% capital gains discount, even after 12 months of the ownership. And it could cause some problems when you take money out of the companies because of those tax rules prevent you to do so, which is called commonly Division 7A. However, don't automatically assume that company is a bad structure for property ownership. If property is a positively yield, company pays maximum of 30% tax, which can be lower than your individual marginal tax rate. And you can retain the profit within the company and no further tax needs to be paid until it gets distributed to shareholders. Also, company can provide better asset protection against any personal claims against you. But you may need to use some advanced structuring techniques to ensure your valuable asset is protected. In short, own a property in a company could be a good option for those with the marginal tax rate is higher than 30%, or nature of your job or other circumstances are exposed to some sort of high risk. You can consider a company as an ownership structure. But if asset protection is your priority, you better use another structure, which is the next structure, which is a discretionary trust, often called family trust. Before we actually jump on to the next one, this is the summary of pros and cons of a company. Trust can be quite tricky to understand how it actually works. But let me read out my own definition of it first. A family trust is a type of discretionary trust that is a legal arrangement where a trustee holds assets for beneficiaries, with the discretion to determine how and when the assets or income are distributed among them. With trust, you can have a greater level of asset protection because the way the family trust works is that there is no ultimate owner, so in case of personal claims against the beneficiaries, like family members, the assets held in trust cannot be accessed by creditors. The reason why I said greater level of asset protection is because of this reason. Company provides asset protection as well, but the shares owned by shareholders can be forfeited, then ultimately lose the company and the asset held in company as well. However, with family trust, this doesn't happen, simply because there is no fixed entitlement such as shares in a family trust setup. And the other benefit of owning property in a family trust is income splitting. Income of trust is distributed in flexible manner to beneficiaries. Trustee, which is a controlling role of a trust, will decide every year how income will be distributed. And also, family trusts are eligible for 50% CGT discount. Sounds like a perfect structure. But hold on a sec. I personally believe that the family trusts are the best structure to hold properties, but it also has drawbacks. Firstly, there are costs involved to set up and operating costs such as accounting fees and other compliance costs, which could be a deal breaker for some people. And secondly, in many states, trusts pay more land tax because of lower thresholds are applied for family trusts in states like Victoria, Queensland, and New South Wales. If you want to know more about trust for property investment, I actually posted a dedicated video about trust, so click the link above if you want to watch it. In summary, the pros and cons of a trust structure is like this. The last structure of the day, which is a SMSF, Self-Managed Super Fund. The self-managed super fund is basically your own private super fund, and this is the only way you can buy properties in super fund directly. This is a great option for many people because of many tax benefits like 15% tax rate on income and 1/3 CGT discounts for assets held for more than 12 months during accumulation phase. CGT is exempt for all assets during pension phase, but threshold called transfer balance cap applies, which is a limit on total amount of the superannuation that can be transferred into retirement phase. And another benefit is ultimate asset protection. It's almost untouchable. However, there's no perfect world. Some of the drawbacks are like, generally speaking, you need approximately $250,000 in combined super balance between members in order to buy a property in your super. However, even $250,000 is tight for property investment. Depends on the type of property you want to buy in super. And setup and annual cost is quite high and highly restricted, and non-compliance could cause serious issues. And you cannot pull out equity because it is owned in a totally separate entity from you. If you want to know more about SMSF, I also already posted a video about SMSF. So if you are interested, please watch the video and the link should be above somewhere. These are the 5 structures, and the summary of all structures are like this. If you want a copy of this summary page, I will leave the link in the description below so you can download it. I hope you now have a clear understanding about the pros and cons of each structure. So how can you actually choose the one over the others? Choosing a right structure is often not that straightforward, although you know the basic details of each structure. And often different structures can be used in combinations as they are interconnected. So if you want to set up a solid ownership structure strategies, I strongly recommend you to speak to a property expert accountant before you buy properties, because once you sign the contract, it's more likely too late. If you like today's video, please hit the subscribe button and leave the comments below for any questions. Thank you for watching, and I will see you in the next video. Bye for now.